This episode is brought to you by Ocrolus. Better lending starts with better intelligence. A borrower's cash flow only tells half the story, so Ocrolus fills in the rest with behavior signals and industry benchmarking. Visit ocrolus.com to learn more. Hello, and welcome back to the Fintech Takes podcast. Today, as we always do at the beginning of every month, we have an episode of Fintech Recap with our friend and the publisher of Fintech Business Weekly, Jason Mikula. Jason comes back, as he always does, to help us recap what's been happening in fintech and banking over the last month or so. Stories we covered today include a really wild and complex story that Jason wrote about in his newsletter. We do our best to recap it briefly and then to talk more broadly about what it means for the current state of policy, politics, and how it affects the way that banks and fintech companies are thinking about their business and planning for the future, and why that's become a little more complicated. We also talk about banking as a service, one of our all-time favorite topics. A new banking as a service bank has just come online, and I think it tells us a lot about where the industry is today versus where it was even a couple of years ago, and where we might be going, and the viability of banking as a service as a business overall moving forward. And then finally, we cap things off with some really nerdy talk about Fed master accounts and the Federal Reserve. I apologize if this section of the podcast is a little esoteric. It's an esoteric topic, but it also is very, very important because, as Jason and I and our friend Kia Hazlitt and others have been writing about recently, what the Federal Reserve does and how the Federal Reserve is organized matters a lot to banks and to fintech companies and to crypto companies and stablecoin issuers, and really anyone who has a stake in the way that our sort of essential financial services infrastructure works in this country. So we spend some time trying to untangle the knot that is Fed master accounts. And we end, as we always do, with some rants, including on a topic that Jason brought to me, a little tidbit of news that caused me to absolutely lose my shit. So make sure to stick around for the very end of the podcast. And as always, I hope you enjoy a great episode of Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, well, crawling through the muck and the AI slop and all the nonsense out there, our friend and intrepid fintech reporter, Jason Mikula, is here. Jason, good to see you, buddy.
Good to see you, too. This is actually, by the time this comes out, I will ostensibly be on vacation in rural France, assuming it has not burned down, because we also have widespread fires in Spain and in France at the moment. But I think the friends we're going to, I think their region, I believe, is safe. So hopefully I'm drinking a nice glass of red wine and relaxing for once.
Excellent. I wish that for you. I will tell you that I similarly find myself in kind of late stage summer forest fire-ish range now. It hasn't been too bad in my neck of the woods. And by the time this comes out, I will be just a couple of days away from the annual Sweet Pea Festival in Bozeman, Montana, which is like, it's kind of our Woodstock, but we do it every year. And there's music, there's art, there's theater, there's really delicious food that I only get one time a year. So this is like my summer happy time festival right around the corner when folks listen to this.
Ooh, that sounds lovely. You have to send me some pics.
I will send you some pictures. I will post a picture of what a sweet pea is in case people don't know. It is a type of flowering vine that is able to be grown in Montana, which is not something that we can always say about everything, but that particular flower thrives here. And Jason, I feel like on this podcast, sort of complicated, intricate, but important fintech news and recaps thrive here. So would you like to start us off with, I think, what is by far like the hardest story maybe ever we've had to try to unpack on the podcast?
Yeah, absolutely. I mean, this is, as a side personal note, this is why I love writing, because despite our friend Kia's encouragement to keep it below 5,000 words, I can just go on as much as I want to. And when you and I speak, we have to try to keep it to like a reasonable length. So I did debate deleting this from the outline altogether, given just how convoluted of a story it is. So it'll be difficult to do justice, but I will try. Also, standard disclaimer that this is not a political podcast. You and I are not talking about politics. And I will do my best to stick to the banking, fintech, crypto, and policy pieces of this story. Yes, I am talking about Alt5 Sigma, also known, sorry, I'm laughing already, as AI Financial Corp, as well as its banking as a service-esque subsidiary MSwipe, which is also known as StrataCart or StrataCarty.
There are so many names already, Jason.
it really was torture to try to even write about this because everything changed names multiple times. Okay, so given our time constraints, I'm going to try to keep this summary high level so that we can actually discuss it. Folks who are interested in all the nitty-gritty details, I would suggest that they give the full story a read, and I will drop the link in the show notes. The TLDR is that Trump-linked World Liberty Financial, which I assume folks have probably heard of, as well as other investors, invested, and I'm putting air quotes around that, $1.5 billion in this firm called Alt5, which is kind of like a paymentsy looking company, which itself has a very weird history going back to its origins in literally the 1970s as, I kid you not, an appliance recycling company. World Liberty's plan basically appeared to be to use Alt5 as a publicly listed treasury company for World Liberty's WLFI token, which I don't spend a ton of time in crypto space, but for folks who followed Michael Saylor or the company MicroStrategy, which of course is now just known as Strategy, that's sort of like the quintessential treasury company strategy, although that is primarily focused on Bitcoin. For Alt5, this approach has not panned out. It appears primarily because the WLFI token plummeted from an initial price of about 20 cents a token to around 5 cents a token. So that public company treasury strategy, it can work when the price of the token is going up. It does not work very well when the price is tanking.
Right.
Alt5 itself actually had to borrow money from World Liberty, which hilariously, it pledged WLFI tokens to secure the loan, which is just the kind of circular logic, I guess, we've come to expect. Sure. And the company has issued a going concern warning, meaning it is warning shareholders that it may not continue to operate as a business. That whole bucket of crazy has been covered fairly extensively across mainstream business press and crypto press. The piece that has been overlooked, which is really what caught my attention, was a Canadian subsidiary of Alt5 called MSwipe, or as I said, also going under the name StrataCart. And multiple sources I spoke to, which really got me turned on to this story, indicated that MSwipe was behind some of these quote unquote no-KYC crypto card programs that I and others have reported about previously. So basically leveraging MSwipe and MSwipe's underlying bank partners and program managers to issue these cards that in turn are topped up with crypto and used for various purposes, whether legitimate or illicit. In the course of researching and reporting this story, I actually reached out to MSwipe to ask questions as if I were interested in using the service for card issuance, and a company representative.
My favorite part of the story by far. Like it's the best.
going undercover, I guess. A company representative, as well as the API documentation, explicitly made clear that they do offer, and they use this terminology, no-KYC cards, ostensibly for the purpose of media buying. And here I should make clear that, like, this isn't necessarily unusual. I've written about what I sort of describe as this corporate card issuing loophole. And it's not specific to M-Swipe or to, the banks or program managers I mentioned in the piece. Corporate cards, basically the common practice is that you're underwriting or you're doing due diligence on a company entity, let's say Workweek, and you're not necessarily doing KYC or collecting information for each individual card that is issued to a hypothetical person, say Alex Johnson. So it's not necessarily like, oh, this is like, totally unusual and illegal and bad. I would characterize it more as a loophole that some bad actors are aware of and take advantage of. So that is the 30,000 foot summary. A lot of different questions that this brings to mind. But I mean, the first one that occurred to me is, and I caveated that this isn't a politics podcast. So, bear with me. Under the current administration, we have seen a pretty significant centralization of control over bank regulators under the Treasury. And of course, we've seen various cases in the Supreme Court, most recently Trump v. Slaughter, that sort of aligns with that philosophy, throwing the asterisk that I suppose we're accepting the Fed from that for historical reasons.
I wrote about those historical reasons in my newsletter if people want to like really delve into why the Fed is supposedly sacred and untouchable, but that's a totally different can of worms.
That, by the way, that was a great newsletter, and I need to buy that book and add it to my never-ending Kindle overflow
It's
list.
a good one. It's a good one. Yeah, it leaves you with the impression that like we're never going to have a financial system in the U.S. that makes any sense at all. So that was kind of my key takeaway. But to your point, and I actually think it's relevant to that exact point, which is we historically, and I would argue almost kind of our political culture in the U.S. is one of like fear of centralization, fear of centralized power, preference for decentralization, even if it doesn't make a lot of sense. We have to keep the 12 individual reserve banks for the Federal Reserve around and give them some level of autonomy, which we will talk about in a little bit. But to your point, a lot of kind of federal financial services regulation and policymaking seems to be not even like decentralized across all the different federal agencies, but really being driven out of Treasury.
And I guess the question I have is, what does this sort of brave new world of not only more centralized decision-making and policy-making, but that decision-making and policy-making, again, with a possible asterisk of the Fed for now, being basically directly accountable to the executive and the executive branch, like what does this brave new world mean for companies that are overseen by the federal banking regulators, particularly given that, as I've said endlessly and will continue to say endlessly, it's like you don't know what's going to happen in the midterms in 2028. And so how do you think about, if you're a company applying for a bank charter now, there are plenty that has conditional approval, and you're trying to sort of mobilize and operationalize that charter. Like, I do not envy the companies that are in the position of having to navigate this situation. That is not a question, but what is your what is your hot take from that prompt, other than being glad that you are not at a company that has to deal with navigating this particular political regulatory environment?
It's tough, man, because to your point, like the politics of it are so fraught that, like right now, there's really not much that like Democrats in Congress can like functionally do because they don't control anything. And so, so like they can write, Elizabeth Warren can and will write sternly worded letters, and that'll stir up a little bit of press in some regards, but there's no like functional like oversight at all, really. And so, it's interesting because we're headed towards the midterms. And if you're a business trying to sort of think through this, like your calculus changes a bit when you have to think about, okay, like if Democrats take back one or both of the chambers in the midterms, like oversight and the way that like the politics around a lot of this stuff potentially changes quite a bit. And, it's interesting because there's a lot of companies that have done quite well for themselves being pretty explicitly aligned with the administration and seeming to have a good time kind of rolling through the sort of regulatory apparatus, right? We've talked about Erebor on the show in the past, just about to raise more money, which I promise I'll circle back to. We have Augustus. Is that the new one that just got a national bank charter? Not a trust charter, like a full national bank charter.
And I did not realize that. I think Peter Thiel is also an investor in, or his firm is an investor in Augustus, which I would, little side quest. I would encourage people to go read like the press release or read the website, because it is very explicitly geared towards like promoting dollar dominance and Western values, which for some reason reading that just like made me vaguely uncomfortable.
Well, it felt like it has this very like almost Trump-esque combative sort of way of framing what they do in terms of like, making America great again is kind of like the subtext of the marketing on the page, which tied to the fact that they have investors who are sort of well connected in the current administration. The whole thing feels like it's coded to sail through an otherwise sort of tough regulatory environment or just regulatory process. And I should note, as a side note, Augustus's CEO is 25, if I'm remembering that right.
Yes.
Which would make him the youngest CEO of a national bank in the US for the last like 100 years or something. And so like these are, let's say, unusual companies in various ways that are sort of getting through this process. Another example of this that I find kind of interesting is, even something like the current kind of ethics debate that's happening around Clarity. Have you followed any of this?
Unfortunately, I have, because I am a glutton for punishment and have not deleted Twitter from my phone as I'm supposed to. The word unprecedented, has been used so many times in the past decade that it has lost all meaning. But to have, and I suppose, to be fair, it's not, it's not just Trump. When I see like Senator Cynthia Lummis, who's like a Bitcoin maxi, and then out promoting, obviously owns this asset, and then is out promoting legislation that would be, beneficial to basically her personal financial position. Ethics. There doesn't even seem to be a pretension anywhere in government, not just the executive branch, but I know we don't need to talk about congressional stock trading from either party, but there doesn't even seem to be a pretension of caring about attempting to look like ethics is something that is a consideration.
I think that's right. And I think if you sort of apply that one step further and you sort of step into the future, whether it's post midterms, if it goes more in the direction of Democrats, or post 2028, if when there's a new administration, like there's really no reason to think, if you're a business trying to navigate this environment, that all of this won't swing back vengefully the other way, right? And so like just like game theory for a second, like right now, it's really beneficial to have a person prominently connected to the administration involved in your business as an investor. As we've seen with the prediction markets, they both have, Don Jr. as a like strategic advisor or investor in their businesses. Like these things are assets right now that smooth the way on a bunch of different stuff. they could become not just not assets, but like severe like detriments to a business under a different political environment, which could happen relatively soon. And so I just think like it would make me cautious as a business to not maybe try too hard to game the environment that I'm in right now, because the way in which I sort of game that environment might come back to bite me in a pretty significant way not too far from now. So that polarization element, I think, is perfectly illustrated by this weird story where it's like, I'd never heard of any of these companies you're talking about before you did the reporting on them. But like the fact that I guess I wasn't shocked that they were connected to all of this at the same time. Like it feels like if you want to try to do a thing and you don't care about like doing it carefully, you're not really thinking about the long term or like sustainability, there's a very open avenue to just driving as fast through a big loophole as you possibly can. But it doesn't seem like a sound long term business strategy. And that's the part I'm kind of continuing to pay attention to.
Well, and I wonder, and I frankly don't even have a good thesis about this of like,
yeah,
okay, so particularly when you're talking about granting charters,
sure,
and this is a little bit of a different but related topic. There are a couple of high APR lenders that are looking to acquire banks. Enova, my former employer, and Alt5 are both, in the process of trying to acquire banks, and those are proposed acquisitions that, frankly, never would have happened under prior Republican or Democratic administrations. There's just sort of this, rightly or wrongly, regardless of what is spelled out in the law, this sort of, let's say, distaste for either granting a de novo charter or approving the acquisition of a bank by a lender whose business model has more than 50% charge-offs, like Enova's does. And so, I don't even have the framework to think about, like, okay, let's say that those acquisitions go through, which I strongly suspect they will. Like, what if anything, can be done, would be done in a different administration in 2029? Like, can you unring that bell even if you wanted to? We probably need to ring up like Todd Phillips or Todd Baker or some bank lawyer to ask them that question. One of the Todds, because I frankly don't have a good mental model for thinking about like stuff that's been sort of signed off and codified now. If you want to unwind or change that, how plausible is it to even do that?
Yeah, well, I mean, another example of this that obviously was referenced in your story, but we should kind of tie a bow around is World Liberty Financial applied for a charter, right? And my understanding of the current moment, as of us recording this, is that that charter has not gotten conditional approval yet. In fact, it is one of the ones that is kind of hanging a bit longer than they normally do. Like, it's been a little bit of a slower process, which would make sense given that it's rife with all kinds of conflicts and problems and connections to foreign governments and all kinds of things that you wouldn't normally see in a bank charter application. And yet, the reporting that I'm seeing, and this is all kind of sourced from like anonymous sources at the OCC and elsewhere, but also is sort of logical, is that there is an expectation that it is going to get approved and that approval may happen relatively soon. And like, to me, that's another example of, like, is there any way in hell that charter would get approved under any other conditions except the ones we find ourselves in right now? And, I think you and I have talked about this in the past, but like, regulatory agencies, particularly ones that were founded during the Civil War, which is the OCC, they care a great deal about institutional credibility, right? Or at least they have historically. And so they'll do things where it's like not really what like the folks in charge want, but they're like, yeah, but we're the OCC. We have this tradition of doing it this way. Like, they're very obsessed with tradition to the point of getting in fights over like portraits hanging in hallways in various buildings and weird shit like that. One of my favorite stories of all time. And, I think this is the kind of activity, this is the kind of stuff that fundamentally like alters an institution like that's permanent like credibility. And so I just am very curious to like, I'd love to get an inside look at like the deliberations happening, because I think, it's probably a foregone conclusion that that's going to happen and that these things need to go through and these things need to be approved. But like the long-term cost to institutional credibility and some of these things, I don't think we can say what that is yet, but it doesn't seem great.
I mean, my last thought, and then we can move on to slightly less fraught topics. I think the question of credibility sounds very like cerebral and academic, which I can totally understand why people might respond that way. But if, and frankly, it's probably not if, it's when there is some kind of financial crisis, you want the institutions that are in charge of responding to that, which, to be fair, is probably less the OCC and it's more the Treasury and the Fed. But you want the institutions that are in charge of responding to, a potential, some kind of like financial economic market crisis. You want them to have credibility because that is that's what makes them effective in formulating a policy response. And
the market has to trust that what they're doing is going to work and that they're going to follow through on it. Like the market has to trust them, essentially.
Yeah, exactly. And I think, maybe this is like a black swan scenario or, something that is unlikely in the immediate or near term. But I mean, you look at, we've talked about, I don't know if you and I've talked about this on the pod before, but we've talked about, the state of private credit. Obviously, there's all this stuff around AI CapEx, which is just insane gobs of money that boggle my mind. Stuff in the stablecoin space, which I strongly believe, I would wager on Polymarket actually, that at some point, like there is going to be a stablecoin issuer bankruptcy, which I learned from your repost of, I think, Todd Phillips. That depending on the type of stablecoin issuer, it would be the FDIC that would be in charge of resolving it. It's like at some point, bad shit, and I never curse on the pod. At some point, bad shit is going to happen, and you want the people who are responding to those unfortunate situations to both be competent, which, let's be honest, the financial regulators are a little bit better than some of the other some of the other departments. But you want them to both be competent and credible. And right now, I guess the fear I have is that some of the federal regulators are trading away that credibility, which one day they will need. And I will put a pin in my soapbox there.
I think all of that is totally fair. Jason, with your story, we weren't visiting Bass Island, but I feel like we were circling in the general direction of Bass Island, since the underlying company that you sort of did your reporting on was Bass or Bass adjacent. I have another sort of Bass story for you. Increase, a company that I believe you are familiar with, just launched a bank. Woo! Yay! Where did this come from? What is this? How did this happen? All right, a little bit of background. Dara Buckley, who was the first non-Collison employee at Stripe way back in the day, started Increase, which is to put it in the terminology of the show, a Bass middleware platform in 2020. 2020, as I think many folks are aware, was kind of the high watermark in this sort of general sense. Everyone's launching a fintech company. There's a need for lots more infrastructure. Increase, among many others, was seeking to provide that infrastructure. Increase has in the past worked as a Bass middleware platform with banks like Blue Ridge Bank, a bank who has come up multiple times on this podcast and who is no longer in the banking as a service business. First Internet Bank, who it still works with, and then more recently Grasshopper Bank, who it still works with. Its customers on the front end, the fintech and fintech adjacent customers, include very large companies like Ramp, Stripe, who obviously Buckley has a connection to, and Gusto. Interestingly, and this is something I've written about in my newsletter, I think you've mentioned it as well, Dara tried to buy a small community bank, Washington Business Bank, in 2022 and 2023. That attempt was repeatedly rebuffed by the FDIC, and he settled for taking a smaller stake in the bank and a board seat, ostensibly for the purpose of sort of learning more about how banks operate. Later, he bought a controlling share in Twin City Bancorp and its subsidiary Twin City Bank, based in Longview, Washington. This was in 2025, so last year. He filed a change in bank control notice and received non-objection from the FDIC. So, in line with what we've been talking about, 2025 was a better year to try these things than it had been in the past. And at the time, he told, I believe it was TechCrunch, quote, Twin City Bank shouldn't support sponsor banking. Sponsor banking requires very specific capability and capacity to supervise partners safely and soundly. Only specialized banks should do it. Well, fast forward to today, 2026, and apparently the bank is now ready to be a specialized bank able to do sponsor banking. So Increase Bank, the rebranded bank built on top of this charter, will still keep its one branch in Longview, Washington. It will keep its existing very, very small commercial banking business. These are the things you do for like good optics so that, Michelle Bowman doesn't accost you at dinner and accuse you of charter stripping. However, the renamed bank will obviously be focused primarily on sponsor banking, fusing together Increase's proprietary developer-focused tech stack, which is built around a homegrown core system and ledger, with their bank charter. A couple of notes. The bank itself is very small. It's got a little less than $100 million in deposits. It's got $114 million in assets, 16 people, a single branch. It is a very, very small community bank. And I think the reasonable expectation is that it will likely remain similarly small for the short term, at least. Obviously, it doesn't really have the balance sheet to absorb anything big on the lending side, as you and I have talked about many times in the past, and has bitten other banks in this exact business. Regulators don't like it when you grow deposits too fast. And so I would expect that it will be fairly cautious as it relates to growth, at least from a balance sheet perspective, in the short to medium term, which likely means it'll be focused more on transactional business opportunities like facilitating payments, which is a lot of its business today anyway. It will also be keeping its existing bank partners, at least in the short term, First Internet and Grasshopper, so that it can continue to support its existing customers and support areas where the bank charter and balance sheet might not be a good fit at the moment. Jason, as the student of banking as a service, as the author of the definitive book about banking as a service, I would like to ask you a couple of questions about this story. The first one is the age of like BaaS middleware platforms, indirect platforms, side cores, whatever language you want to use to describe this thing, that doesn't have a bank charter, is the era of those companies kind of over? Because obviously we've seen a few banks kind of go in this direction. We've seen some banks like the Bank Corp or Cross River sort of start as a bank and then invest more in building out the tech side of their business. We've seen the opposite, where we have tech entrepreneurs like Jackie at Lead or William at Column go buy a bank charter and then refashion it into a banking as a service first bank. So for these platforms we've talked about, Synapse obviously being the most infamous one, but there's lots of others that have done a better job and haven't collapsed into bankruptcy. Is there really a market for those anymore? Is that era sort of over? This episode is brought to you by Ocrolus. Every small business runs on its own financial rhythm. Revenue patterns and operating cycles look completely different across industries, and financial data alone doesn't capture that context. Ocrolus turns financial data into decision intelligence, pairing AI-powered cash flow analytics with borrower behavior signals and industry benchmarking. Underwriting moves faster, and credit decisions get more consistent. Visit ocrolus.com to learn more.
Are you asking, is middleware dead?
That's what I'm asking. That's what I'm asking.
I usually try to avoid that formulation because it's a little bit clickbaity.
Yeah.
I want to sit down and write something on this, as I mentioned at the top. That is how I formulate and like focus and pressure test my thoughts. But my initial reaction is probably yes, right? So if I think about what we might call like the middleware era, right? Yeah. And if I'm remembering off the top of my head correctly, I think Synapse was founded, it was either 2016 or 2014.
That's so funny. I was just thinking those two dates. But yeah, it's like...
I can't remember which. It doesn't matter.
Split the difference, say roughly 2015. Yeah.
But I would agree with your statement that kind of like the high watermark was that, call it early COVID, right? Yeah. When like money was free and everyone believed that everything was going to be only online forever, which in retrospect,
every company will eventually be a fintech company, I believe, right. Was a rallying cry of this era. Yeah.
Yes. And if I try to think about like the sequencing here, it's like, okay, that whole crop of what we are referring to as like middleware players, and that's like obviously Synapse is bankrupt and gone, but you're sort of like Unit, Synctera, it's Treasury Prime, etc. Like they solved a real problem.
For sure.
Now here in 2026, looking backward, I guess the question or the way I would frame it is, was it a durable solution with a durable business model, or was it a Band-Aid? And the real answer, the real solution is what you've just described, right? Which I've been sort of dubbing these like BaaS native banks. If you have a better term, I'm totally open.
I don't have a better term. I wrote a piece a long time ago where I called these BaaS cores, which I meant by that was
that's a good piece.
Combining matter and antimatter, meaning like the bank charter and the developer first infrastructure, which historically have been hard to fuse together, right? Yeah. Because it can create instability, it can create problems, like the power of that is also the danger of that. And so regulators were always a little nervous about it, but it feels like we're post that. And now, like, I mean, the increased thing makes me think we now know how to kind of create and safely operate warp cores that combine these two sort of diametrically opposed things together. And you don't need a middleware platform sitting in between them. I mean, even like referencing Blue Ridge again, like it's the Blue Ridges of the world that make you need BaaS middleware, right? Because you have a bank that doesn't really know what it's doing, that's not prepared to do banking as a service, who someone's nephew just convinced them to get into banking as a service because they heard about this fintech thing. And they had no hope of like selling to fintech companies, integrating with fintech companies, managing a ledger on behalf of it. Like none of that would have worked if it was just the tiny little community bank that didn't know what the fuck it was doing. Sort of in charge of that. And so middleware like eliminated the need to touch those things directly while you still needed those things. But like those market conditions are changed now. They're not the same.
Well, and I would add a dimension to that beyond, the bank itself, which I think your points about like being able to sell to fintech on, and onboard from like a sort of like a commercial standpoint is fair. But I mean, I think the root problem, as all things in community banking go back to core banking providers, FIS, Fiserv, Jack Henry. And so it's like now, with the benefit of hindsight, I think it is a fair argument to make that class of what we're calling middleware was a temporary solution to the fact that core providers generally suck and were not, they were not responsive, and they were not meeting the needs that existed in the market. And so you had that generation, but here we are, depending on when you want to count, I suppose almost a decade on from when Synapse was founded. And it's like, hey, actually this middleware approach, for all sorts of reasons, is kind of janky
and clearly,
clearly introduced some risks and some problems. And ultimately, like, it was a workaround for both economic reasons. I think we've discussed sort of like how core banking providers tend to price on core accounts, as well as technological reasons, lack of API access. And so instead of relying on this sort of jerry-rigged system, if you could build your Bass Warp Core in your language or your Bass native bank, where, hey, actually, we don't need this extra layer, which is introducing additional complexity and also is another mouth to feed from the economics perspective. Like, if we don't need to build this Band-Aid on top of FIS, Fiserv, Jack Henry, whatever, we actually just build it to accommodate this business model a la Cross River, Lead, Column, and now Increase, then we don't need this additional complication and this additional company that is taking a cut of revenue. And so I do think, is it going to be today, tomorrow? No. Might we see like a Synctera or a Unit, companies in that class, in that category, might we see them also pursue what Increase is doing and try to acquire an existing bank, try to apply for a de novo charter? I think that's certainly a possibility. But like the standalone middleware was kind of caught in between a rock and a hard place. You and I love our metaphors. In the sense, it's like, well, you have the core providers that are like, hey, we're going to try to meet that need. Although I think I would argue that they still haven't actually done that. Has anyone heard anything from Atelio lately? Are they alive?
I don't think they are inside FIS. I think they're not alive. I think that didn't go so well. FIS is where good technology goes to die. I think that's a joke I made like 100 years ago when I first sort of encountered the core providers. But yeah, I mean, like that need is not solved for. But it also hasn't stopped either tech entrepreneurs from acquiring banks, to your point, or like banks that are serious about banking as a service, finding their own solution for it. And that could be getting like a newer core and using it in a side-along fashion. It could be building their own internal tech stack. But like, I think one other element to all of this is, in 2020 and 2021, there was such a mismatch between demand and supply, right? And so the demand was, every person in the world was starting a fintech company. Every ounce of institutional capital in the world was being funneled into fintech, it felt like. And so like literally everyone was like, I want to start a fintech company. I have a VC giving me a check for $10 million to start a fintech company. I need a bank in order to bring my fintech company to life. And I cannot get a bank charter because we still were living in the era of, no, you may not have a bank charter unless you're Jackie Reeses and you thread the needle exactly right. So what am I going to do? I have to work with a bank. Oh, there's not that many like banks out there that do this. There's only Bancorp and a couple others. And then in comes this surge of community banks and then middleware platforms on top of them that meet this incredible demand for these things. And you fast forward to today, the demand is still there, but it's lesser, right? Like, I don't think we're ever going to see 2021 again. Like, I'm going to be bouncing my grandkids on my knee, telling them about the VC funding for fintech in 2021. And they'll be like, why do you make us come to grandpa's house? And I'll be like, because this is really important history. And then at the same time, and this, I guess, is the last part of the story. I don't know, Jason. Right now, the window, as we've talked about, for charters is wide open. And I think two things about that are interesting. One is, I think it might signal a future in which the charter window just stays more open. And I don't mean to say that it's going to be as like much of a free-for-all as it's been lately, right? I mean, now it's like, if you have the right connections, you're getting a bank charter. If you use the right language on your website talking about making the dollar great again, you get a bank charter.
Hire the right consultants, you're getting a bank charter.
Hire the right consultants, you get a bank charter. Have the right people on your board, you get a bank charter. It really, quite frankly, it's a stunning failure on Wise's part that they didn't get a bank charter. Come on, man. Like that is embarrassing. But I think that, even after we get out of this era, like, wasn't the lack of new bank charters, wasn't that really kind of an artifact of like the 2008 financial crisis and kind of just this general tightening of all the regulatory apparatus? Like for a while, it was kind of a bipartisan stance reacting to the great financial crisis. I wonder if this is the moment where that particular fever kind of breaks. And even under a Gavin Newsom administration in 2028, like, they won't be as wide open, but like, I think they'll be more acquirable perhaps. And then I think as a consequence of that, the other question I wanted to ask you real quick is, is banking as a service a good business for anyone anymore? Because I think about like Increase, and obviously Increase is very sophisticated in terms of its tech stack. I've heard really great things from fintech companies that are looking for like really great kind of close to the metal developer-centric infrastructure that they can build around. And obviously they have the greatest developer-first companies in the world building on top of them, Ramp, Stripe, companies like that. But like, I mean, I'll just use Ramp as an example. Shouldn't Ramp be getting a bank charter? Like, is there any reason why Ramp shouldn't get a bank charter? Like, they should get a bank charter. And if they get a bank charter, and Stripe already kind of has one through Bridge and might do other things. They actually have a couple because they have that weird Georgia thing too. Like, these companies should get bank charters while they're available. And if they do, that doesn't mean that they're going to entirely migrate off or stop using Increase altogether. But it puts pressure on even the Increases of the world. I've written about Column before where it's like, at some point they're losing Mercury because they're now a bank. They lost Brex because Capital One bought them, right? So like, there's this graduation problem that now exists even for the best BaaS warp cores or BaaS native banks that I don't think makes BaaS quite the goldmine that it was perceived to be in like 2019.
No, I think that's right. I mean, the lens that the graduation frame, I think is a good one. And then the other related lens I think about is like the supply demand lens. And it's like, okay, so now we have, depending on how you want to count it, your Column, Lead, Cross River, Increase. Like what is the right number on the supply side? And then to your point about graduation, like there's also the risk that actually as the supply is going up, but the demand decreases to the extent that it is feasible from like a charter window perspective, and the economics make sense depending on what the line of business is. Vero. So it's like again, I'm glad that we sit in our chairs with our microphones and I don't have to be making like the very elaborate PowerPoint trying to analyze like, what do we think is going to happen 5 years from now as far as like a business plan if you're Increase getting the charter, if you're a Column thinking about, okay, like what happens when a Mercury leaves or when a Brex leaves. Because I think it is a fair analysis to say part of the explosive demand for what we call BaaS was that it was functionally impossible to get a charter for like 15 years. Yeah. And now, and frankly, to be clear, I think that was a bad thing, right?
Yeah,
like
me too.
If you look at the UK, and I'm not going to profess to be like an expert on the UK market, but the structure, well, one, they have alternate license categories. So there's e-money institution, which is like not a concept that exists in the United States. Yeah. And two, it's like more feasible, and there are more pathways in place to start and stand up a bank, being cognizant like that it may not be successful. And I think the post-2008 vibe in the United States very much reads as the regulators had no appetite to see banks fail. Yeah. And one way to make sure that a bank doesn't fail is to not grant one a charter in the first place.
Right.
So, I think, again, using our pendulum metaphor, we're seeing the very sharp reversal of that. That is something I'm interested to sort of follow, and you and I can discuss endlessly over the next 5 years. Like, not all of these newly chartered banks are going to be successful, and
some may fail in spectacular and novel ways. It'll be interesting to I mean, like, Jonathan Gould, I think, at the OCC has gone on the record and said basically like it's healthy to have some banks fail, right? And like I think there's a lot of validity to that point, and like regulators' lack of comfort with having a single bank fail was kind of what kept us in the stasis. It's like, yeah, I mean, it's not a natural way that the market should work. But yeah, I wonder like in a 2028 administration if Dara and William and Jackie will very quietly be lobbying the regulators to be like, maybe don't grant quite as many bank charters. Because like, it's not in the interest of anyone who's trying to make a go of it in banking as a service for the charter window to be as wide open as it is. But, I think it's one of those things that remains to be seen how it works out. Jason, time for one more story?
Yeah, I mean, I suppose it's kind of related if we're talking about master accounts.
Yeah.
Everyone, I can't tell if you, me, and our text chain friend and your colleague Kia just like live in a bubble where we just talk to each other constantly. But other people have been talking about master accounts as well. Capital account, which I can't afford to subscribe to.
Me
but,
neither.
They also had an interesting tidbit related to comments Comptroller Gould made regarding master accounts recently. For those who are unfamiliar with...
Which is the vast majority of you, which is fine. You're living your life. You're like a hit at parties. That's great for you.
Yeah, you probably don't want to think or talk about this ever. But functionally, a master account is an account that a depository institution, note that I did not say an insured depository institution.
I did note that with interest.
Holds at a Federal Reserve bank, one of the 12 regional Federal Reserve banks. For the purposes of what we're likely to chat about right now, the key attributes that it gives account holders are direct access to various Federal Reserve systems, including FedWire, Fed Securities Service, FedNow, Fed ACH, National Settlement Services, Check Services, and FedCash. Also worth noting, where applicable, master accounts are a prerequisite for tapping the Fed's discount window. Honestly, to your point about the 17 people who actually care about this topic, it has been my impression until fairly recently that master account access was like kind of an esoteric and like relatively benign topic.
It was like that Julie Hill wrote about it, and that was it, kind of thing.
And that it was really kind of the explosive growth, primarily of crypto, even more than fintech, that changed that in like early 2020. Because as I mentioned, per statute, to be eligible, you do have to be a depository, right? And so, for example, there are state chartered depositories like Wyoming special purpose depository institutions that in theory under the law should be eligible. But as any parent can tell you, just because you are eligible for something does not mean that you automatically get that thing.
You are not entitled to it. Yeah.
Eligible, but not entitled. And so, Custodia, and I'm guessing folks who bother to listen this far to the podcast are probably familiar with Custodia and its long-running lawsuit against the Fed related to master account access, being sort of like the poster child for crypto fighting for access to this, and the Fed kind of, depending on your point of view, saying no, stonewalling, etc. So this led to demands for sort of like increased transparency, which in 2022, the Fed rolled out some additional guidance that defined 3 specific tiers of Fed master account applications. So to try to simplify this, tier 1 was eligible institutions that are federally insured and subject to federal prudential supervision. Tier 2 was eligible institutions that are not federally insured, but were subject to additional Federal Reserve oversight or federal prudential supervision, which is kind of weird because like there's not that many entities that fall into that bucket.
I know. It's a small group.
And then tier 3 being eligible institutions that are not insured and are not subject to federal oversight, federal prudential regulation. So that would be, for example, the Wyoming Speedies. Other examples, Connecticut. Connecticut has long had an uninsured charter that it recently rebranded as like the Innovation Charter, which I just think is funny branding. Nebraska has a similar crypto charter. And then I would also put, I don't know to what extent it would be relevant for the purposes of a master account, but I would also put the Georgia MALPI, you mentioned Stripe's weird charter. It's the Georgia Merchant Acquiring Limited Purpose Bank charter.
And to note on the tier 3, it's almost like if you're a state, you have to kind of craft this very specific charter to hit this eligibility thing. Because like in the case of Wyoming, as an example, like the use case for getting this Wyoming special charter, it doesn't, it's not really a bank in the way we would recognize it, right? So when we say uninsured, really what we mean is they're not lending out your money or doing anything, right? It's like for stablecoin issuers and stuff like that. And so like if you get that charter, you're a depository in the sense that you're taking people's money, but you're not a depository in the sense of you then like lending the money out or having NIM as a business model, which is why you don't need FDIC insurance. And so it's kind of like this strange, like kind of in between quantum state where it's like technically we're a depository institution, but we don't have to be insured, meaning that we don't have any level of federal supervision. And I think in some ways that's kind of what the Fed is sort of drawing a line around right here, right? Where they're like, if there's any part of your business that requires us or any of our friends at a federal level to supervise you directly, you're lower risk from our perspective. But if one of these weird states who we don't really trust can just give you a bank charter, but you're not subject to any of our supervision, Fed, OCC, FDIC, NCUA for that matter, like if you're not subject to any of our supervision, we can't, we technically have to legally consider you for an application, but historically, we have not liked this and we don't really want to give you a Fed master account. And that's where the consternation comes from.
Yeah, absolutely. I mean, to your earlier points about how weird and bizarre the United States banking system is. So the reason you put the story in the outline is because Kraken ostensibly was approved, and it made headlines, like a big news story, both in crypto world and in TradFi world. And the news release was this March, but if you look at the date of the actual approval in the weird Federal Reserve webpage that lists this stuff, the date is in like the end of January. That Kraken was approved for a tier 3 master account. Because I am sad and have no life, I watched a YouTube, and because somebody sent it to me, I watched a Wyoming state hearing where the CEO
Those
of
are
Kraken,
on YouTube, Jason? I didn't even know that. That's like, that's a game changer for me.
where the CEO of Kraken Financial, which is that bank subsidiary, the Wyoming chartered bank subsidiary, was giving an update on the business and saying that they had not yet actually operationalized that account. I believe Kia also wrote, at least in passing, about the Kraken bit. And on Kraken's website, if you want to deposit money, you're still actually wiring that money to Dart Bank. So still like not operationalized, still relying on a third party for wire transactions. The point I was making about the very strange U.S. structure, when I was researching the bit I wrote on Kraken and its master account, I came across a tier 3 entity, another tier 3 entity that was approved, and it is a bank in Puerto Rico, the Cooperativa de Ahorro y Crédito, and that's because it has insurance. It does have deposit insurance. It is a bank in the way that you and I would traditionally think about banks, but the deposit insurance is through the territory of Puerto Rico. It's not FDIC, nor is it NCUA, so it's considered a tier 3 entity. And then Numisma, which is also just kind of like a weird business model around distributing physical banknotes, was approved for tier 3 access. But as far as like what crypto advocates and also increasingly certain corners of fintech world that are pursuing these national trust charters are interested in, we really at this point have not seen an entity be approved and operationalize an account. And I mean, I guess the question or the topic that I find the most interesting, that I know, you and I and group chat world have discussed to some extent, is this sort of disconnect between the Federal Reserve Board, which is formulating these sort of guidelines and policies, including the so-called skinny master account, or more technically, I believe we're referring to that as a payment account, on which comments were due earlier last week, or I guess 2 weeks ago by the time we published this. versus the 12 individual Federal Reserve banks, which, per your excellent piece summarizing some of the Fed's history, those are corporations that are privately owned by their shareholders. Who are the shareholders of those 12 regional banks? They are, the commercial banks that, are on Main Street, Wall Street, that people use as depositories. And so I guess my not very well-formed question to you is, does this system make any sense?
I'm going to go with no.
Is it tenable? I mean, we also didn't even get to some of the executive orders around access to payment systems in general, some of the very specific stuff about whether or not ACH is included or excluded in the skinny accounts. There's a lot of very sort of technical but important details that people are fighting over right now. And I'm curious, sort of broadly, what are you hearing, and what is your point of view on how this hot mess is unfolding?
Yeah, I mean, it's really weird, right? Because as you illustrated in your history, the Fed has been very reluctant to give out these Fed master accounts to novel, risky, what is now considered tier 3 applicants, the strange sort of novel ones that they just don't really like or don't trust,
or don't understand.
They're like, we don't know what this is.
To be charitable.
Yeah. We don't know what this is. This doesn't look like what we're used to approving as a applicant for a Fed master account. And to your point, this is the Fed giving out bank accounts to new companies, basically, right? And the bank account comes with access to all their payment services. It comes with daylight overdraft. It comes with access to the discount window. So there's all these things that are bundled into a master account. And so that generated a lot of controversy, particularly with Custodia, because the decisions that were being made were weird and opaque, and there was no guidelines around it. And if you wanted to put your finger on the specific reserve bank that was at the heart of this, it's our friends in Kansas City, who will just make weird decisions, seemingly, and decisions that the board in Washington, D.C. doesn't understand, doesn't have a role in, can't stop. And so, Kraken is a good example. Governor Waller comes out, I believe, late last year and starts talking about the skinny master account idea. And he's like, this will be a streamlined way that we can get these more novel, innovative institutions access to payment services and Fed services, and kind of floats this idea out there, then has to clarify shortly after, because people interpreted his remarks to mean we're going to give access to crypto companies, fintech companies, all these non-banks. No, he says, we are legally not allowed, according to the Federal Reserve Act of 1913, modified by the Monetary Control Act of 1980. There's a little history for you. We are not legally allowed to give it out to anything except a bank, a depository institution. What I meant was the master account could help with this small category of weird novel charters that are having a hard time. Okay. Then it's reported that Kraken has indeed gotten not only a tier 3 approval, but it was framed in the press as this is the first one of these skinny master accounts. Yay! And people were like, well, that's cool, but I thought you hadn't even finalized your proposal on what a skinny master account is. How did Kraken get one? And then Michelle Bowman on the Federal Reserve Board, who's in charge of bank supervision at the Fed, has to come out and say, well, this is more of a trial or a pilot program. And it's limited, it's time limited. We're just using this to kind of learn, the window for skinny accounts is not open. We're still accepting comments on our proposal for skinny master accounts. And once we have that and we learn from the Kraken, then maybe we'll do something. But of course, the problem, as you point out, is Michelle Bowman can say that all she wants. Governor Waller can say these things all he wants, but they're not the ones in charge of deciding who gets master accounts. It's Kansas City and San Francisco and Boston and New York and all of the different reserve banks. They all independently have the authority to do this. So that all should just illustrate the sort of context around my answer to your question, which is, no, this does not make any sense at all. This is not the way that it should run. Just as a sort of point of contrast, this is not at all how it works in other countries. I did a little bit of research when I was writing my Fed piece just on is every central bank around the world as weird as ours? And the short answer is no. And in particular, a lot of other central banks around the world really sort of segment off their payment rails from other things that they do, right? And so the idea in the US that a master account bundles both access to lender of last resort mechanisms like the discount window with payment services is a uniquely American thing that really wasn't even something we like sat down and designed intentionally. It was just the result of all these weird historical accidents and compromises over time. And if you look somewhere else like Brazil, India, there's lots of examples, even the UK, they take a much different approach where they can, on the one hand, give limited access to their payment rails directly to companies to encourage innovation and competition and less reliance on banks. And then on a completely other hand, can give access to banks for access to lender of last resort, supervision, all the things that the other side of the Fed does. And so the Federal Reserve has kind of bundled all of these things together. And that when we talk about master accounts, really it's the manifestation of that bundled authority that the Fed has that's the root of all of these problems. And yeah, to answer your question, makes no sense. And honestly, like I'm not even really sure what the Fed can do about it because they're going to come out with this proposal. Maybe the proposal can get some level of consistency going, but at the end of the day, the board can do whatever it wants. It's not their decision. And they can't even stop or really even slow down the reserve banks from doing whatever they want on this issue. And I short of changing the law, I don't really see how it's possible.
Yeah, I'll admit, it almost pains me to agree with the crypto maxi people. But I mean, a couple of things about this that just from like a public policy and like a good governance perspective that do like really rub me the wrong way is the complete lack of transparency and accountability that you're just, that we've described, right?
The Fed does not have to explain any of these decisions.
Like, I know it may sound a little like naive and Pollyanna-ish, but it's like, hey, like, shouldn't we have a clear set of rules and guidelines that are equally and fairly applied to anybody, any company, any qualified company that is seeking to have this access? And, some of the narrative, I think more so from crypto world, but you get this from some parts of what I'll call more like traditional fintech world as well, is that, banks are basically fiercely guarding their regulatory privilege in a manner that is unfair and anti-competitive.
And you see that in the comment letters to the Fed on this proposal, by the way. Like, do not doubt that the Bank Policy Institute weighed in on this question of skinny master accounts. And shockingly, they don't love the idea. Not a fan.
And, sometimes those arguments, I think, from crypto fintech world sometimes can be a bit disingenuous, but in this case, like I'm really quite sympathetic where it's like, oh, okay, so the Kansas City Fed or the Chicago Fed is the one that ultimately has the power to decide this application. Who's on the board of that Fed?
Yes.
Oh,
yes. It's these like ex Fed officials, or it's these bankers from banks that, like, again, to your earlier point, the Federal Reserve banks are private corporations. They're sort of like these weird quasi government regulated private corporations, but like they have bank shareholders. Like they're not answerable to the public the way that the Federal Reserve Board or other parts of the Fed are slightly more answerable to the public. It's a very strange system that we have.
Well, ostensibly, and I only know this because I had to look it up when I was writing my piece about the Fed or about the master account stuff. Each reserve bank has a 9-member board. 3 are elected by the member banks.
Yes.
To represent the commercial banking industry. 3 are elected by the member banks ostensibly to represent the public. So 6 of the 9 members are chosen by the banks that belong to the regional Fed. And then the remaining 3 are appointed by the Federal Reserve Board of Governors, also ostensibly to represent the public, where the public is sort of this broad, hazy conception of taking into consideration agriculture and commerce and industry and labor and blah, blah, blah,
Sure.
blah, blah.
I don't remember any of those appointments being run past me as a member of the public. And I will also say, just as a little historical note, that the chairperson for each one of those reserve boards, until Dodd-Frank, until 2010, they were actually elected by the banks and were not appointed by the Federal Reserve Board. That changed post 2010 because we got a little uncomfortable with just how unaccountable the reserve banks were, but like took a financial crisis to even modify that, which is kind of strange.
But I mean, I feel like we're already ranting, and I know we're a bit over time. Should we segue to our what we can't let go of, assuming it's not just our master account
official rants? Yeah, this was like a warm up rant. We should. So I promised I would talk about Erebor, our sort of famous and favorite mysterious new bank. It was reported recently that Erebor is planning to raise more money. Now, on one level, I get this because it has brought in a ton of deposits. And as a de novo bank, it has a higher than normal tier 1 leverage ratio, which is essentially the amount of capital that it needs to keep in relation to its assets. And notably, Erebor's Tier 1 leverage ratio is 12%, which is really high even for a de novo bank, which I think is an indication of sort of the novel nature of the bank and some of the concerns that the OCC had. But functionally, what that means is for the amount of deposits that the bank has brought in, and then it obviously deploys that deposits into treasuries, or it doesn't really do much lending yet, but it deploys it onto the other side of its balance sheet. It really can't actually bring in much more in terms of deposits and then deploy them into different assets before it hits that cap that's been imposed on it and needs to raise more capital. So mechanically, it makes sense to me as a de novo bank with this leverage ratio that it has to raise more capital. Okay. Here's the part that doesn't make any sense to me. It, in its last funding round, was valued at like $4.35 billion, which is a lot, Jason, for a de novo bank that at the time had no customers and no deposits. And now that is just Palmer Luckey and friends. We're going to start a bank. That was a big enough number. Apparently, according to reporting from Bloomberg and others, the amount that it's discussing for its valuation for its next round of capital, which again is necessary just to continue to bring in more deposits and start to get whatever lending it's going to be doing up and really running, that would be valued at $8 billion, which is roughly double what it was valued at last time. And I got to say, just as a quick rant, like, do numbers not mean anything anymore? Like, what am I not? Like, Erebor has not demonstrated any ability to be a normal bank and to make money the way a normal bank would. Like, does its investors just not care about getting their investment back? Are these numbers all just made up? Like, what the hell? Like, I don't I don't understand. This fundraise should be thought of more as a capital call from existing investors so that the bank continue to operate, not as a, hey, we proved something amazing about this business and you should give us more money at a higher valuation. This doesn't make any sense. What am I missing?
It does not make any sense. I mean, I do think that fundamentally, like, well, I guess a traditional banking business models feel like a very, very poor fit for venture capital. And yet here we are with Erebor and with Augustus. I'm a little less concerned about all the national trust banks just because it is a bit of a different beast. Not that there aren't risks and potential problems there. But as we've discussed on a zillion other sort of topics, like extremely rapid growth, which is what VC encourages, facilitates, and rewards, tends to blow up pretty spectacularly when you do it in these kinds of businesses, whether it's like non-bank lending, which I've had a front row seat to, or, I mean, deposits, ostensibly less risky, as our friend and colleague Kia would point out, it is functionally debt that you're taking on. But when you're growing extremely quickly, as we've seen in Bass World, and the banks underneath Bassworld, like there do tend to be risks that are accumulating that you need to be taking account of, building appropriate controls for. And it's like the incentives are all out of whack here. And yeah.
It's just weird. It's like either Erebor is going to continue to run itself the way it said it will, which is like very conservative, low loan to deposit ratio. Like we're not going to do anything crazy. We'll just hold on to your money. Cool. But that's not an $8 billion bank that keeps like doubling its valuation every 6 months. Or we're going to take all these deposits that we've rapidly been pulling into our balance sheet, and we're going to try to earn our way to this valuation by doing a bunch of crazy shit. And like, we know what that looks like in banking. And so I don't see any way for either the bank to continue to be safe and prudently run, or for the investors to get their money out at this valuation. Like one of those two things is not true. And at this moment, I can't discern which one, but it makes no sense to me.
It also does not make sense to me.
All right, give me yours.
Alex, remind me, are you a Delta guy?
I am. It's my go-to airline.
Well, then you are in luck, because I just read today that DraftKings and Delta have partnered to launch SkyPicks, trademark, a new free-to-play in-flight sports contest that gives eligible customers age 21 and up an interactive way to engage with sports while you travel. SkyPick. So sorry. So on U.S. domestic Delta flights through Delta Sync Wi-Fi, you will be able to answer a series of sports-related questions, such as who will score first, which team will win, and a final score tiebreaker to compete for a spot atop the leaderboard and a chance to win Delta gift cards for your next adventure. Alex, are you looking forward to the next work-related trip so you can gamble during your flight?
No, I am not. No. Why? Why is this happening? No, this is very bad. Why? It makes me want to just raw dog a flight and just not like look at anything or talk to anyone or engage with the screen at all. No. I'd love to know how much Delta is being paid for this. These soulless monsters who like build these planes as a mechanism. Essentially, Delta's business is, we're going to build a thing where we can just keep a bunch of people hostage for hours at a time and then find ways to monetize those people who were being held hostage in the sky where they can't get away from us. And then we'll just extract a ton of money because of that. I hate it. I hate the fact that, like, at least the way you described it, it sounds more like kind of non-gambling sort of fantasy sports-esque type things, the way that DraftKings actually used to before gambling was legal. Yeah. In the US, which is not great, because then like, okay, my 8-year-old is sitting next to me on the plane and he's like, ooh, look at this. And he's like, can kids play this? Is this
21
regulated by this? Okay, 21 and up. That's at least something. If prediction markets were involved, they probably wouldn't even do that. Like, oh God, no. Ugh, bad.
Yeah, I guess you and I and people in our general age cohort, like, are just going to sound like the old cranky parents, but it's just like, I am continuously just flabbergasted at how everything is just speculation and gambling. Yeah. And I really can't tell if it hits a breaking point eventually and swings back, or if like this is just the new horrible dark mirror reality that we live in.
Well, I mean, the thought I'll add to that, and then I'll let you go, is I do think that the mechanics, the user interface of how we interact with the world being more and more oriented towards gambling is not good, just for like general well-being of all of us in the future. Like, I don't want to walk through the world and see like a car that's like trying to drive through an intersection that's about to change, and in my head being like, I think I want to short the odds that car is going to make it through that intersection. Like, I don't want my mental wiring for how I experience the world to be through a lens of like gambling. But it seems as though Robinhood, DraftKings, Kalshi et al., Delta, now aided by Delta, is trying to just infuse sort of a gambling lens across literally every screen and interface that I might come across. This is why, Jason, honestly, like my wife and I are becoming Luddites as we get older, to your point about becoming grumpy. And like my house is just filled with books, physical books. And that's the only like form factor I trust anymore. Everything else I feel like is like trying to reprogram my brain to make me think in terms of speculation and odds and gambling and making picks. Like this is crazy.
Yeah, don't love it. I don't love it.
Not my favorite. Okay, well, you got my blood pressure spiked with that last one, so that was good. My doctor thanks you. Jason, as always, a delight to podcast with you, and we'll be back at it next month.
Till next month.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.